6.66%. That's the 30-year fixed mortgage rate as of July 30th, 2026, according to Freddie Mac. And at that rate, waiting 12 months can actually beat buying today, depending on where you stand. There is an exact line where that decision flips. It has a name, it can be calculated, and right now you're either above it or below it. Before we get there, you need to feel what 6.66% does to a real purchase. Take the median existing home in this country, $414,300, which is what it's sold for on average in 2025, according to the National Association of Realtors. Put 20% down and you're financing about $331,000. At today's rate, the principal and interest alone come to roughly $2,125 a month. Now stack the rest. Property taxes, roughly $400 a month on a home like that. Homeowner's insurance, call it $150. Maintenance, the furnace that dies, the roof that ages, the water heater on a 10-year timer, a realistic allowance is $350 a month, and plenty of years you'll spend more. Add it up, and the true cost of owning that median home lands around $3,025 a month. Now, the comparison that makes people sit up. The national average rent for a one-bedroom, according to June 2025 report, is $1,636 a month. So the buyer of the median home is paying close to $1,400 more per month than the renter. And we haven't even touched the $82,000 of down payment sitting trapped in the walls, which is a conversation of its own. Run it annually, and it gets louder. Owning that home costs roughly $44,000 to $46,000 a year. When you add the payment to the taxes, insurance, and upkeep, renting runs about $19,500. Ownership at this price and this rate costs around 2.2 to 2.4 times what renting costs every single year before you count a dollar of equity. The obvious pushback? Some of that mortgage payment is principal. Some of it comes back to you. True, but at 6.66%, a lot less of it comes back than the rent is throwing money away crowd wants to admit. And we're going to quantify exactly how much in a moment. So here's the contract. I don't know where mortgage rates are going, and the people paid to forecast them have been wrong for 3 straight years, as you'll see. What actually helps you is not a prediction, it's a decision rule. For any given set of numbers, your local rent, your local prices, your down payment, how long you plan to stay there is a mortgage rate at which buying and waiting are mathematically equivalent. Above that rate, renting another year and keeping your cash invested wins. Below it, buying today wins. It's called the indifference rate. And the uncomfortable twist is where it currently sits relative to the 6.66% on your screen. By the end, you'll know which side of that line you're standing on, not the national version, yours. But before you can judge whether waiting pays, you need the full, honest cost of buying today. And the monthly payment is the smallest part of it. The bigger costs never show up in your bank statement at all. Start with the rate itself, because context decides whether 6.66 is a spike or a plateau. It's a plateau. That rate is up slightly from 6.58 the prior week and down a touch from 6.72 a year ago. Look at the annual averages and the picture gets almost boring. 6.81% in 2023, 6.72 in 2024, 6.60 in 2025. The 30-year rate peaked at 7.79% back in October 2023. And since then, it has done nothing but wander inside a 6 to 7% band for more than 2 years. If your plan assumes the rate rescues you by falling off a cliff, the recent history says the cliff isn't there. This is the terrain. Plan for it. Now here's what that terrain does to the money you send the bank. At today's rates, roughly 55 to 65% of everything you pay in the first 5 years of that mortgage goes to interest. Not principal, not equity. Interest. A cost that behaves exactly like rent, except it goes to a lender instead of a landlord. You'll hear people say, rent is throwing money away. Fine. Then most of your early mortgage payment is throwing money away too, and nobody puts that on a coffee mug. That's leak number 1. Leak number 2 never appears in a monthly statement because you pay it at the door twice. Transaction friction. Buying a home typically costs you 2 to 5% of the purchase price in closing costs, origination fees, title, escrow on our median home. Somewhere between $8,000 and $20,000, gone before you sleep your first night in the place. Selling is worse, 6 to 8% of the sale price, most of it the 5 to 6% commission. The academic benchmark for this whole debate, Baracha and Johnson's 2012 study of 3 decades of buy versus rent outcomes, builds its entire model on 2% in, 6% out on an 8-year hold. That's 8% of your home's value consumed by the act of entering and leaving. On a $414,000 house, over $30,000 that no appreciation forecast gets to ignore. Put the two leaks together and the picture changes shape. The renter's non-recoverable cost is the rent about $19,500 a year. The buyer's non-recoverable cost is the interest portion of the payment, plus taxes, insurance, maintenance, plus an amortized slice of that $30,000 friction. Both sides are paying money they'll never see again. The symmetry the folklore refuses to admit. The only honest question is whose pile of unrecoverable dollars is smaller over the years you'll actually live there. And at 6.66%, that answer is no longer automatic. At 3% it usually was. That's what changed. By the way, I'm Tom, and on Lazy Investor, this is what I do with housing. Treat it as a wealth decision and run the boring numbers the slogans skip. If that's useful, subscribe. It keeps these calculations coming because there's a third leak, and it's the biggest of the 3. It's not on the closing disclosure. It's not in the monthly statement. It's the $82,860 of down payment that stopped working for you the day it left your brokerage account. And what that money would have become is the number that quietly flips this whole decision. Let's make that concrete. Because this is where the math gets uncomfortable for the buy now crowd. That $82,860 doesn't disappear when it becomes a down payment. It changes jobs. It stops being an investment and starts being a wall. And the question is whether the wall pays better than the investment did. Run the counterfactual. Leave that cash in a diversified index portfolio, earning a 7% real return, and after 12 months, it's worth roughly $88,700. Not life-changing, you say? Hold it. At the end of a 7-year hold, the same 7 years you'd plan to stay in the house, that same down payment grows to about $155,300. $72,000 of growth generated by money that never touched a house. That's not a rounding error in this decision. That's the engine of it. Now, is 7% real a fair benchmark, or am I reaching? The long-run record says it's actually conservative. The S&P 500 has delivered about 10% nominal, 7% after inflation per year across the long sweep of Robert Shiller's data going back to 1871. And if you think the modern era is somehow weaker, the most recent 10 years, 2015 to 2025, came in around 12 to 13% annualized nominal. I'm not asking you to believe the recent decade continues. I'm asking you to grant the century and a half average. Meanwhile, what does the same cash earn inside the house? Only the home's appreciation, nothing else. No dividends, no reinvestment, no compounding beyond whatever the local market hands you, and the forecast for the next year or two sits somewhere between 0 and 3%, which we'll put under the microscope shortly because they carry more weight in this decision than you'd expect. So the comparison on the table is this. Your $82,000 compounding at the historical market rate, or sitting in drywall, earning somewhere between nothing and 3%. Over 7 years, that gap doesn't add up, it multiplies. And there's a second penalty stacked on top, liquidity. The day your cash becomes equity, it stops being available. You can't rebalance it, you can't spend it, you can't redirect it into the portfolio when the market drops 20% and everything goes on sale. Getting it back out means either selling the whole house at the friction we just priced or borrowing against your own walls and paying interest to access your own money. At this stage of your life, flexibility has a dollar value and the house spends it. So here's the causal chain, and I want you to hold on to it because everything after this hangs on it. Your down payment sets your opportunity cost. That opportunity cost decides whether renting with the difference invested compounds faster than owning. And that compounding gap is what rewrites your net worth number 20 years out. The mortgage rate only matters because it controls how wide that gap opens. This is also why the folklore phrase about throwing money away skips half the ledger. Everyone counts the renter's check to the landlord. Almost nobody counts the buyer's 2 rents. Because when you buy with a mortgage, you are renting twice. You rent the money from the bank at 6.66%, and you rent your own down payment to yourself at 0. The first rent shows up as interest on a statement. The second only shows up as the portfolio you don't have. Both are costs. Only one of them comes with a coffee mug slogan. None of this means waiting is free. It isn't. and pretending otherwise would be the same folklore wearing a different hat. Because while your cash compounds, $19,500 a year in rent is walking out the door, and the housing market never signs a contract to hold still while you decide. If prices move against you over those 12 months, they can eat years of careful math in one gulp. So the honest question isn't whether waiting has a return. It does, and now you've seen it quantified. The question is what waiting costs, and that side of the ledger has a few surprises of its own. Start with what you can count with certainty, the rent. 12 months at $1,636 a month comes to about $19,600 gone. That's the sticker price of waiting, and it's real money. Nobody gets to wave it away. But before you treat that number as fixed, look at what the rental market is actually doing right now. Because the standard assumption baked into every buy now argument is that your rent climbs every year while you sit on the sidelines. At the moment, that assumption is flat wrong. Median asking rent across the 50 largest metros was $1,696 in October 2025, down 1.7% from the year before. That was the 27th consecutive month of year-over-year decline. Nationally, rent growth is running near 0 to 1%, which is about as close to frozen as the rental market gets. This is not the historical norm, and it won't last forever. But you're not making a decision about forever. You're making a decision about the next 12 months. And in these 12 months, the escalator that supposedly punishes the renter is barely moving. The waiter's rent in month 12 is likely to look a lot like the waiter's rent in month 1. That quietly removes one of the biggest costs the buy today side usually stacks on its side of the scale. Now, the other cost of waiting, the one that genuinely deserves your respect, prices. If you wait a year and the home you wanted costs 10% more, every calculation in this decision is ash. So ask what the price data actually says, rather than what the fear says. Nationally, appreciation ran 1.64% in 2025. The median existing single-family home sold for $421,900 in April 2026, up only about 0.9% from a year earlier. That was technically the 34th straight month of year-over-year increases, which sounds bullish until you notice the trend inside the trend. The increases are decelerating month after month towards zero. The Case-Shiller National Index for March 2026 came in at plus 0.7% year over year. And after seasonal adjustment, the national index actually fell on the month, and more than half of the metros it tracks posted outright annual declines. More than half of the tracked metro markets got cheaper over the past year, not more expensive. The professional forecasters see the same stall. Fannie Mae's panel of over 100 housing experts projects national price growth of 2.9% for 2025 and 2.8% for 2026. And both of those figures were revised down from the previous quarter. P. Morgan's housing research desk goes further. 0% nationally in 2026. Not a crash, not a boom, a market treading water. And underneath the national average, the map is split in two. Chicago is up 6.1%. Seattle is down 2.5%. Denver is down 2.0%. Depending on your metro, waiting a year either costs you something or pays you something. And the national headline tells you almost nothing about which one you're in. The 10% price jump that would destroy the waiter's math exists almost nowhere in the current data. But a 2 or 3% drift exists in enough places that you can't ignore it either. So put the honest cost of waiting on the table. Roughly $19,500 of rent against a price risk that the current evidence describes as somewhere between flat and 3%, with a real chance your specific market is falling and the wait actually makes the house cheaper. That's the full bill for the waiter's year. Set it next to the buyer's side of the ledger, which you've already seen price the interest, the friction at the door, the growth the down payment gives up, and something should click, because this is where the whole question changes shape. Notice what you've been doing for the last few minutes. Pricing scenarios, not predicting. And that's the way I want you to see everything that follows, because everyone who asks, should I buy now or wait, believes they're asking a forecasting question. Will rates fall? Will prices rise? What will the Fed do? They're not. And no forecast deserves that kind of authority over your balance sheet anyway. The real question is an allocation question. You have a pool of capital, the down payment, plus the monthly difference between owning and renting. And that capital is going to compound somewhere for the next 7 years. In a portfolio, at the long run market rate. Or in drywall, at somewhere between 0 and 3. The forecasting question is a distraction from the allocation question, and the allocation question has a computable answer. Once you see it that way, this stops being about guessing the future and becomes about comparing two balance sheets 12 months apart. One where you hold a deed, a 6.66% loan, and a pile of paid interest. One where you hold a lease and a portfolio that got another year to compound. Both are real positions. Both have a price, and you've now seen both prices. And when two sides of a decision each carry a measurable cost, there is always a line where they cross a single number where the two balance sheets come out identical. That number exists for you personally, it can be calculated from figures you already have, and it has a name. That line is the indifference rate. And with both sides of the ledger now priced, you can see exactly why it sits where it sits. Start with the variable that quietly governs the whole decision, how long you stay. Break-even horizons stretch with the rate, and they stretch more than most buyers imagine. When buy versus rent models ran the numbers at a 4% mortgage, the cumulative cost of buying caught up to renting around year 5 or 6, stay past that, and buying pulled ahead for good. At a 7% mortgage, that same crossover doesn't arrive until somewhere between year 8 and year 12. The difference between a 4% world and a 7% world isn't a slightly higher payment. It's an extra 3 to 6 years, during which the renter with the invested down payment is beating you. And if your realistic hold is 7 years about what the typical buyer plans a high rate means, you can move out before buying ever wins. You carried the friction, you bled the interest, and you left before the payoff arrived. Now, you could reasonably suspect this is all model talk spreadsheets stacked on assumptions. So here's the scoreboard from the actual market. First American ran the analysis in the second quarter of 2025, and they did it the fair way. They counted the buyer's equity gains, not just the costs. Even handing the buyer that credit, renting made more financial sense nationally and in 36 of the 50 largest markets. That's the widest margin in favor of renting since 2011. Buying still won in 14 metros, almost all of them in the Midwest and Northeast, where prices are low relative to rents and the math never broke in the first place. So when someone tells you buying always beats renting, the current data says that's true in about a quarter of major markets and false in the rest. The folklore has a zip code. And here's the twist everything so far has been walking toward. Take the full ledger, the monthly payment gap, the down payments foregone growth, the friction at the door, appreciation running somewhere between flat and 2%, and solve for the rate where buying and waiting come out dead even. For a 20% down buyer planning a 7-year hold on national numbers, that 12-month indifference rate lands almost exactly at 6.66%. The rate on your screen right now, the headline number isn't an argument for buying or an argument for waiting. It's the boundary itself, which means the national buyer is standing directly on the line. And which side you fall on comes down to which scenario the next 12 months actually deliver. So what do the forecasters expect those 12 months to deliver? Not the internet forecasters, the institutions whose money rides on being close. Fannie Mae's September 2025 forecast has the 30-year rate ending 2026 at 5.9%. And notice that figure was revised up from a prior forecast of 5.8%. So even the optimists have been walking their optimism back. The Mortgage Bankers Association, in its January 2026 forecast, projects roughly 6.0% by the fourth quarter of 2026. Two of the biggest forecasting shops in the country saying the same thing. A drift down of maybe 50 to 75 basis points over the next year is within the range of reasonable outcomes. A collapse of 200 points, the return to the fours that half the internet keeps promising, appears in no major forecast. None. If your plan requires that collapse, you don't have a plan. You have a hope with a payment schedule. And notice the shape of the bet this leaves you with. The realistic case for waiting is a modest rate drop, 3/4 of a point, if the forecasters are right for once. The realistic case against waiting is a modest price move, 0 to 2.8%, if those same forecasters are right. Two modest numbers pulling in opposite directions. And they don't resolve independently, they fight each other on the same ledger at the same time, and the arithmetic of that fight decides who wins. Run the arithmetic. Take the optimist case first. The forecasters are right, and over the next 12 months, the 30-year rate drifts down 3/4 of a point, from 6.66 to 5.91%. On the $331,000 loan, that drop cuts principal and interest by about $175 a month. Call it $2,100 a year. Over a 7-year hold, that's close to $15,000 of payment relief. That's the full price for waiting, and it's real. Now the other side of the same 12 months. Suppose prices don't stall. Suppose your market lands on the forecaster's middle case and appreciates 2%. The same home costs about $8,300 more. And that extra cost isn't a one-time fee. It's baked into the purchase price and financed at the new rate, so it follows you for the life of the loan. Measured against the $2,100 a year the rate drop saved, the price increase wipes out nearly 4 years of those savings in a single move. Wait a year, catch the better rate, pay the higher price, and you only pull meaningfully ahead around year 5. That is the fight, and on national numbers, it ends close to a draw. The two effects are sized to cancel each other. Once you see that, the scenario matrix writes itself, and it has 2 live boxes. P Morgan's 0%, while rates drift toward 5.9. Waiting wins, and it isn't close. You pocket the lower rate, pay the same price, and your down payment spent the year compounding in the portfolio instead of sitting in drywall. Box 2. Prices rise 2% while rates stick near 6.5%, which is roughly what the bond market has been delivering for 2 straight years. Buying today wins you lock the price, and the rate relief never arrived to reward the waiter. Every realistic future sits between those 2 boxes, and which box you land in decides the answer. That is why the decision rule matters more than any forecast. The forecast picks a box. The rule tells you what to do in each one. And while we're cutting assumptions, cut the biggest one, the idea that the Fed is coming to rescue the mortgage market. That is not how the plumbing works. Your 30-year rate does not track the Fed funds rate. It tracks the 10-year Treasury yield. A committee in Washington sets overnight rates between banks. Your lender prices 30 years of inflation risk, and it takes its cue from the bond market, not the press conference. The proof is recent and blunt. The Fed cut rates through late 2024 and again through 2025, and mortgage rates stayed above 6.5% for most of that stretch, because the bond market looked at the same inflation data and refused to follow. Central bankers cut, lenders shrugged. Fed action is not mortgage relief, and any plan that assumes the two move together is built on a pipe that isn't connected. So notice where this leaves you. Nobody asked you to predict anything. You're holding a decision rule and a pair of scenarios. And at 6.66%, you are standing close enough to the line that the next 12 months of modest numbers will tip you one way or the other. But one assumption is still holding this whole matrix up, and it deserves its own stress test. Everything so far has granted the most popular escape hatch in housing. Buy now at whatever rate, and if rates fall, refinance out. Date the rate, marry the house, you've heard it. It sounds like a free option. It is rarely priced like one. It isn't free, it isn't guaranteed, and the fine print is where that plan quietly dies. Start with the cost, because refinancing is not a phone call, it's a transaction. Refinancing typically runs 2 to 5% of the loan amount in closing costs on a $331,000 loan. That's somewhere between $7,000 and $16,000 paid a second time on the same house. And that money resets the break-even clock we just spent minutes building. Every year of equity building you'd banked gets pushed back because you just added a fresh layer of friction to a decision that already had $30,000 of it. If you refinance in year 2 and move in year 6, you may never cross the line at all. You'll have paid 2 rounds of transaction costs for a house that never got to win. Then there's the qualification problem. Refinancing is an option, not a right. You have to qualify, and qualifying assumes you have the equity. Picture the buyer who's stretched to get in with 5 or 10% down, the exact buyer most tempted by the refi later pitch. If prices stall at 0% or dip the way they already have in more than half of tract metros, that buyer's equity barely moves. The loan-to-value ratio stays too high. The lender says no or says yes, only with mortgage insurance attached, which is another $100 or $200 a month that builds nothing. That buyer isn't dating the rate. They're married to it at 6.66% for years, paying insurance for the privilege. The escape hatch has a lock, and the key is appreciation, the one thing the current forecasts refuse to promise. Now look at the mirror trade, because it exposes what these escape hatches really are. Instead of buying now and hoping to refinance, plenty of buyers pay to lower the rate upfront discount points. 1 point costs 1% of the loan. On a $400,000 loan, That's about $4,000. And it typically buys your rate down only about 25 basis points, 0.25% for the life of the loan. Do the comparison that almost nobody does. The waiter is paying rent and hoping rates fall 0.75 of a point. The points buyer is paying $4,000 cash to manufacture a 0.25 point drop today. Same bet, opposite direction. Both are spending money now to buy a lower rate. And here's the uncomfortable symmetry. If waiting 12 months for a 50 to 75 point drift is a gamble, then paying $4,000 for 25 points is a gamble you've already prepaid at 3 times the price per point. The points only pay off if you hold the loan long enough for the monthly savings to cover the upfront cost, which takes years, and every refinance or early move torches the whole calculation. These aren't two different strategies. They're the same wager on the same uncertain future, wearing different closing documents. Which brings us to the part of the line nobody can hand you, your version of it. Everything I've run so far uses national numbers, national median price, national average rent, a 7-year hold, 20% down, a 7% real return on invested cash. Change any one of those inputs and the indifference rate moves, and it doesn't move by a little. It moves by roughly a full percentage point in either direction. Take a buyer in San Francisco, where prices are stratospheric relative to rents. The price to rent ratio is stretched so far that the renter's side of the ledger is cheap by comparison. For that buyer, the indifference rate can sit near 4.5%. 6.66 isn't a boundary for them. It's a blowout. Waiting wins, and it isn't close. Now, take a buyer in Detroit or Cleveland or half the Midwest metros where buying still beat renting. Even in First American's analysis, prices are low, rents are high relative to prices. The monthly gap runs the other way. That buyer's indifference rate can sit near 7.5%. At 6.66, they're below the line, and buying today is the wealth decision, full stop. Same country, same headline rate, opposite answers, separated by about 3 points of indifference rate and 1 zip code. And your line moves with your own numbers, not just your city. A longer planned hold pulls the line up because the transaction friction gets amortized over more years, and the buyer's equity has more time to compound. A bigger down payment pushes it down because more trapped cash means more foregone portfolio growth. A higher assumed return on your investments pushes it down further. 4 levers: local price to rent, holding period, down payment size, and your expected investment return, and every one of them is yours, not the market's. The bond market doesn't get a vote on your line. Your lease, your timeline, and your brokerage account do. That's worth pausing on, because it inverts the way this decision usually gets made. Most buyers treat the mortgage rate as a national fact. They're forced to react to 6.66, take it or leave it. But the rate on the lender's screen is only half the equation. The other half is a number you construct yourself out of your own circumstances. And 2 buyers standing in front of the same loan officer can be standing on opposite sides of the decision without either of them being wrong. The question was never whether 6.66 is high or low. The question is whether it's high or low relative to your line. If you're getting value from watching the math actually run instead of the folklore repeat itself, that's what Lazy Investor does with Housing Every Week Subscribe. And bring your own numbers to the next one. So the national line sits at 6.66, but your line is personal. It shifts a full point by city and situation, and it's built from 4 inputs you can write down tonight. Which means the only thing left is to put the whole machine together, 1 executable rule you can run this week, and the honest answer to the question in the title. Here's the rule. And it's a chain, not a checklist. Your local rent versus your full ownership cost, payment, taxes, insurance, maintenance sets the monthly gap. That gap, plus the opportunity cost of your down payment, sets your personal indifference rate. And where today's quoted rate sits relative to that line decides whether your next 12 months belong to a lease and a portfolio or to a deed. That's the whole machine. You can run it on a napkin with your own numbers this week, and you should. Because the national answer doesn't get to move into your house, you do. So, the honest answer to the title. At 6.66% on national numbers, a 20% down buyer planning a 7-year hold is standing on the line, and the ledger tips slightly toward waiting 12 months and keeping the cash deployed. Not by a landslide, by enough to matter. In a high price, cheap rent metro where the price to rent ratio is stretched to breaking, you're already past the line. And waiting isn't a close call, it's the clear play. In one of the markets where prices sit low against rents and buying still wins even after the renter's invested down payment is counted. You're below the line, and buying today is the right trade. 3 different answers off one headline rate that's not hedging. That's what a decision rule looks like when it's honest. And the line isn't frozen where you found it. 3 things pull it toward buying. A, quote, roughly 3/4 of a point lower than today's, a shift in your local price to rent ratio as prices stall against flat rents, and a longer holding period, because every extra year amortizes the friction at the door. Watch those 3 numbers, and you'll know the moment the answer changes, and not one of them requires predicting the Fed. That's the part the housing conversation keeps getting wrong. It treats the house as an identity, when the house doesn't care what you call yourself. The house is either a wealth decision or a lifestyle decision. Pretending it's both is how the math breaks. If your numbers say wait, then wait. That's a position, not a failure. Subscribe to Lazy Investor, because the line will move before the housing headlines notice. And when it does, you want to already know which side you're on. Know which side you're on.